Welcome to Market Movers. I'm Jim Uriel, and we are a week away from another OPEC meeting that could have major implications on oil prices. We're looking at using CME crude options, either hedge risk or perhaps create additional exposure. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, so the CME's OPEC tool, which is relatively new, gives it a 63% chance of a small production cut and a 37% chance of no move at all. Are you comfortable with that? Do you think that's what's going to happen?
So you're telling me there's a chance,
yeah.
as the saying goes. Yes, Jim, I'm comfortable with that because of the fact that that's actually been increasing and the fact that the markets have seen just a complete washout in oil price over the last couple of weeks. So it seems like there would be some action to try to say buoy prices a bit.
And just as an aside, the methodology on that new tool is pretty interesting. They take different contracts and figure out what the market thinks. But anyway, so if you want to check that out more. But okay, so you said the massive move, 35% move in crude. By the way, in the last 5 years, that's the fourth biggest move. Crude sometimes moves far in a short period of time. So is this enough to make them blink and cut production?
I think so, because to your point, there has been some more volatile moments in the past, Jim, but this is one that just feels like it is completely overdone from the look at the charts and look at the fundamentals too. So to me, that's why I think the cut production looks good.
I actually agree with you. So now, before we dive into our trade discussion, I'd like to point out with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements will vary. These are both priced off the Feb contract, was trading 51 even, Scott.
Yes, so believing that there is some, say, hope maybe in the crude oil price here moving forward, I believe there are some good opportunities out there to take advantage of if maybe a bullish stance here, at least maybe a little bit of a bounce back after looking at those charts over the last, gosh, Jim, week, 3 months, 6 months, whatever.
Yeah.
I mean, anything looks like it's due for maybe a bit of a bounce here. So specifically, Jim, looking at buying today, the week 3 December CL 53.54 call spread for 40 ticks. This trade risks 400 to make a potential 600. It expires Dec 21st, as you mentioned. The underlying is roughly about 51 even, and it just is looking at the fact that things are completely overdone in the charts. I believe they're overdone too on the fundamental scares, and therefore, if we get a little bit of a retracement up, I like the expression on this call spread.
I like counter trend here because it has moved fast. I definitely like the direction. I like using options to do that. But what I think, though, and I'll see if I can get you to agree with me, because my trade's a little bit different, because I think sometimes these bear market relief rallies are vicious and can go higher. So I'm looking at buying the week 3, the same expiration, the 57.5 call spread for 60 ticks. It risks $600 to make a potential 19. Again, goes off Dec 21. My theory behind it is if we start rallying, there's a lot of shorts in there, this move could be exaggerated real fast. And we might not get to my levels, and that you might have to manage it, take it off for a double, something like that. Thoughts?
Good call. And let's face it, the old rubber band, as it were, is stretched. So if you do get a bounce, it's probably going to be vicious and it's probably going to be quick. And so in your expression, I like the fact, it scared me a little bit when you started saying, oh my gosh, 55, because it seems so far away.
Right.
But as you manage that expression, as we do with a lot of these expressions that we have on market movers, you can take them off, you can roll them up, whatever you got to do if you get that risk reward
and both
working
these
out.
trades have a little more time in them than when we usually do, so they won't get zapped away just on single events.
I agree. Another thing to consider too, if the markets calm down, let's just say on the equity side, say on the ES, and the dollar maybe starts to pull back too, maybe there is a bounce in commodities in general.
We're running out of time, but I want to get this in here. Is Saudi Arabia feeling the pressure of Donald Trump? In a word.
Absolutely.
I agree. Thanks for joining us on Market Movers. I'm Jim Uriel, where we're helping to make you a better trader.